making these money-losing investment moves? Why average investors earn below-average market returns. Investor behavior is illogical and often based on emotion. That does not lead to wise long-term investing decisions. Here's an overview of a few typical money-losing moves that average investors make. Studies show that when the stock market goes up, investors put more money in it. And when it goes down, they pull money out. This is akin to running to the mall every time the price of something goes up, and then returning the merchandise when it is on sale, but you are returning it to a store that will only give you the sale price back. This irrational behavior causes investor market returns to be substantially less than historical stock market returns. What would cause investors to exhibit such poor judgment? After all, at a 6% return, your money will double every 12 years. Rather than chasing performance, you could simply have bought a single index fund and earned significantly higher returns. Tip: want to estimate how long it will take for your investment to double? Use the rule of 72. Divide the number 72 by the anticipated rate of return to arrive at a rough estimate. Overreacting during times of uncertainty. The problem is that the human reaction to good news or bad news is to overreact. This emotional reaction causes illogical investment decisions. This tendency to overreact can become even greater during times of personal uncertainty, near retirement, for example, or when the economy is bad. There is an entire field of study that researches this tendency to make illogical financial decisions. It is called behavioral finance, and it documents and labels our money-losing mind tricks with terms like recency bias and overconfidence. Investors believe they can predict the future. With overconfidence, you naturally think you are above average. For example, in one study, 81% of new business owners thought that they had a good chance of succeeding, but that only 39% of their peers did. 5 In another study, 93% of U.S. drivers rated themselves in the top 50% of drivers in terms of skill. When it comes to investing, overconfidence causes investors to exaggerate their ability to predict future events. They are quick to use past data and to think they have above-average abilities that enable them to predict market movements. Popular books, like Carl Richard's The Behavior Gap, also do a great job of explaining the behavioral decisions that lead to the large gap between market returns and actual investor returns. Despite the research and education, the gap continues. What can you do to avoid the fate of the average investor? How to avoid losing money. One of the best things you can do to protect yourself from your own natural tendency to make emotional decisions is to seek professional help and hire a financial advisor. Use a disciplined screening process to find the right advisor for you. An advisor can serve as an intermediary between you and your emotions. If you are going to manage your own investments, you'll need your own way to keep your emotions out of the buy-sell process. Consider using the 4 tips below to make smarter decisions. 1. Do nothing. A conscious and thoughtful decision to do nothing is still a form of action. Have your financial goals changed? If your portfolio is built around your long-term goals, as it should be, a short-term change in markets shouldn't matter. 2. Know that your money is like a bar of soap. To quote Gene Fama Jr., a famed economist, your money is like a bar of soap. The more you handle it, the less you'll have. 3. Never sell equities in a down market. If your funds are allocated correctly, you should never have a need to sell equities during a down market cycle. 7. This rule holds true even if you are taking income. Just as you wouldn't run out and put a for sale sign on your home when the housing market turns south, don't rush to sell equities when the stock market goes through a bear market cycle. Wait it out. 4. Trust that science works. A disciplined approach to investing delivers higher market returns. Yes, it's boring, but it works. If you don't have discipline, you probably shouldn't be managing your own investments.
Want to know more about finances? Expand your knowledge. And keep updated to have a strong financial view. We from BrandFi, your branded finance, offer our loyal subscribers a free financial updates portal with first-hand information on crypto, Web3, NFTs, blockchain, finance news updates and more. Click the link below to proceed. You will get first-class information far earlier than the rest. But there is more you can and should do. Build multiple streams of income. More and more people realize and learn about their finances. They don't know how and where to start. We offer first-class financial information perfect for your needs. Strengthen your financials, get valid and legit information. Click the link below. Become part of our free offers, no financial obligations. But there is one important thing you have to know. You have to become active and involved. So, do it now. Become active and involved. I see you on the other side, Brand Fi.